Good morning. We welcome you all to the weekly Saturday knowledge sharing webinar organized by Mehta and Mehta. Today is the fourth session on the NBFC master classes, and today's topic for the session is an insight into gist of skill-based regulations. For our today's session, our panelist is Mr. Vishal Solanki. Mr. Vishal is the CFO of the JM Financial Credit Solutions Limited. In his career, he has almost 2 decades of financial service sector and has consistently demonstrated his expertise in the area of financial planning, accounting, auditing, and treasury and taxation. Mr. Solanki joined JM Financial Group in year 2012 and has handled various functions including financial planning and budgeting, finalization of accounts, representation of taxation, matters, regulatory compliances, treasury, and working with internal and external stakeholders. And Mr. Solanki holds a postgraduate diploma in business administration from Mumbai University. Welcome, sir. Our,
Thank you very much.
our second panelist is Mr. Hemant Pandya. He has around 18 years of rich experience across the entire spectrum of corporate secretarial, compliance, and legal functions. His career journey began in 2007 with JM Financial Group, where he is currently designated as Executive Director, Compliance, Legal, and Corporate Secretarial. In year 2010, to pursue a still practice, he joined Mehta and Mehta, a PCS firm, as a partner where he served a diverse range of clients, including listed entities, MNCs, FMCGs, and financial sector institutions. Mr. Pandya holds a Bachelor of Commerce degree and a law degree from University of Bombay. He is also a qualified company secretary and a fellow member of the ICSI. Currently, Mr. Pandya serves as a company secretary and a compliance officer of JM Financial Limited, the flagship company of JM Financial Group. Additionally, he also oversees compliance and secretarial functions of various subsidiaries in the group, which inter alia includes NBFCs and HFCs. In his leisure time, Mr. Pandya enjoys reading, drawing, and sketching, as well as writing articles and poetries. He has been an active contributor to the ICSI, conducted various programs, training sessions to share knowledge and expertise with students and fellow professionals. Welcome, sir. Our presenter for today's session presenter is Ms. Tulna Shah. She is a qualified company secretary and a law graduate with over 3 years of post-qualification experience in corporate governance for listed as well as unlisted companies. Qualified as a CS at the age of 21, securing All India rank 22 in the CS Foundation program and cleared all levels in the first attempt. She has overseen secretarial functions for 200 plus companies and 40 plus LLPs with a strong command over Companies Act, SEBI regulations, and allied corporate laws. She also played a pivotal role in board governance, fundraising transactions, share buybacks, investor communication, statutory reporting, licensing with the regulatory authorities, implementation of ESOPs and CSR frameworks. Tulna is our Ahmedabad partner. And our moderator is Professor Balakrishnan. He's a company secretary having almost 4 decades of experience in secretarial compliances. He has worked with Foseco India Limited and is a regular speaker at ICSI CCGRT. He regularly contributes in various magazines, including Chartered Secretary of ICSI. We thank you all our panelists for today's webinar for joining us on our knowledge sharing journey on behalf of the entire team of Mehta and Mehta. Now I would request Vishal sir to say a few words on the topic and then Hemant sir.
Sure. Thank you very much. Good morning, everyone. Today's session, the topic is very interesting, gist of the scale-based regulation. So, the scale-based regulation has been introduced in 2021 and which was effective from October 2022 by the RBI. And it was introduced due to the size and scale of the NBFCs. So, over the years, the NBFC in India have grown significantly in terms of the size, complexity, interconnectedness within the financial sector. Over the year, many NBFCs, among the NBFCs, many entities have grown even significantly, systemically significant in nature. So and hence their risk profile also changed drastically. Considering all those things, there was a requirement to yeah. So it was hence the requirement of the scale-based regulation was there due to the diverse nature of the NBFCs. So there are multiple NBFCs in the different buckets. So say 8,700 around NBFCs in the base layer, uh, and 569 NBFCs in the middle layer, which requires even stricter regulation, and around 10 in the upper layer NBFCs, upper layer bucket. So total NBFCs are 9,300 around in India. Brief, I'll touch upon some coverage of the scale-based regulation, what changed from the previous things. So in the scale-based regulation, it was introduced for the first time internal capital adequacy assessment process, which could be called as ICAP. So there we need to each middle layer and upper layer need to assess their capital requirement basis the some stress testing. The other thing is the concentration limit they have changed. Single party like earlier was the 15% each for the investment and loans. They have changed to 25% either investment or loan. Sensitive sector they have introduced. Suppose you have exposure to the commercial real estate or say capital market, there you need to have the board approved limit. It was also introduced to have the sub limit. Suppose there was some discussion in direction for the land acquisition financing also sub limit required there. In terms of the governance, for the BL, they have introduced the RMC requirement, Risk Management Committee. And for the middle layer and upper layer, the KMP holding the office requirement, they have mentioned specifically that the KMP cannot hold the office of the other middle layer or upper layer. Independent director restricted to three, middle layer or upper layer. There was some listing requirement also given. If the NBFC is considered as a upper layer, then within 3 years they need to list. There was some disclosure requirement in the financial also, like CG report. If any breaches in covenant or defaults, if any divergence in the asset classification provision, those are disclosure required. So these were the brief things about the scale-based regulation. Detailed one we will see obviously in the presentation, and we'll try to add more things wherever required. Thank you very much.
So, good morning, everyone. Um, it is great to be here. Vishal has introduced the topic very well. He has covered a lot of things, in his presentation in brief. But before I begin, just a quick disclaimer. So everything, Vishal and I belong to the same organization. So everything we share today reflects our personal views and not those of the organization where we work for. Now, let us talk about skill-based regulations for NBFCs. Uh, I mean, since Vishal has covered what we say everything in detail, I don't want to repeat it, but just to give you an idea, how if I want to connect it with the chronology of a common life, so why skill-based and how it is important. So let us talk about skill-based. Think of it like a traffic rules of for vehicles. A bicycle doesn't need a license, okay, but a truck does, because the risk and impact are different. Okay. So similarly, RBI now regulates NBFCs based on their size and importance to the financial systems. So as Vishal said, and we have also seen in our previous sessions, NBFCs are grouped into layers: base, middle, upper, and top. The bigger you are, the more rules apply. This helps ensure that large NBFCs, which touch millions of lives. NBFCs are uh, everywhere, and they touch millions of lives, are stable, are transparent, and well managed. So small NBFCs lending to local businesses has fewer compliances, requirements, and a large one offering digital loans across India. So it's about matching regulations to the risk. So that is how skill base is made of. So today we will explore what these layers mean, how they affect operations, and what NBFCs need to do to stay compliant and resilient. So it's a very detailed this thing, scale-based regulations. Earlier, there were different circulars. They made it into master directions, and all circulars used to come and there was a master directions. But now they have changed it to regulations. So yes, so this is from my side, Bala sir, and
Good morning to all of you. I have a great pleasure in welcoming you all on my own behalf and also on behalf of Mehta and Mehta. We are very lucky to have two eminent people who are really in the field, who are in the practicing for over the decades, who have been with us in the last 2, 3 seminars, also with us, share their thoughts. Actually, we are really going to add much insight things on this. As far as I am concerned, when I talk about a scale-based regulation, it is important because what they have done is, as our panelists said, the different layers. The regulation has actually made a sort of what you call tailor-made regulatory requirements according to the size and the risk which are actually involved. We have one side, they wanted to give the operational flexibility to the small NBFCs, not much of the compliance, etc., and other thing and all. But as you travel upper and upper, the more stringency is actually coming up. Another thing is what has happened in the past reveals there are a lot of scams, etc., which all happen because of the interconnected companies, subsidiary, downstream companies, etc., and other things and all. So here what happens is because the more of the increasing regulatory stringencies, which is actually larger in case of the more interconnected entities. That is what they the investor and the investor protection, because the hard money should not go down the drain. That is the whole idea. That is the reason all this regulation and stringency what we are talking about. So I would like to say from my side, let us go along with the presentation and you can all what is expressed the interpretation and regulatory things what you are coming and very specific cases etc. kindly do not refer, because without knowing the full details we will not be able to answer any such things, because it is only giving a general view of here to it. If you have any specific questions with reference to the particular thing that cannot be getting answered here, that you have to talk to the expert. That is what I would say. With this, I request Tulna to proceed with the presentations. Please start, and if time permits, what we'll do, we'll allow you to speak. You can raise your hands. At the end of the discussions, you can actually speak and you can interact with the people also. Okay. Over to Tulna, please.
Good morning, everyone, and thank you for joining today's masterclass on non-banking financial companies and insight into gist of RBI scale-based regulations. So here's how we have structured today's discussion. We'll begin with a quick recap on the 4 layers of SBR framework. And since many of you have attended earlier sessions, we'll only touch up upon them briefly and move quickly on to other areas. So this is an overview of the RBI scale-based regulations. As you all know, RBI introduced the SBR regulations in 2021 and it came into effect from October 2022. We have already gone into detail on the 4 layers of NBFC in one of our earlier sessions, so we won't repeat that discussion today. What we do want to emphasize is the principle of progressive regulation. So the smaller the NBFC, it faces lighter oversight, and while larger or more complex entities are subject to enhanced regulations and norms as suggested by our panelists. Then opening of branch or subsidiary, joint ventures or representative offices or undertaking investments abroad by NBFCs. NBFCs seeking to expand internationally must obtain prior approval from RBI before opening any such branch or subsidiary or representative office abroad. Aggregate overseas investment is capped at 100% of net owned funds, and exposure to a single foreign entity cannot exceed 15%. Now, it is important to note that only regulated entities abroad are permissible investment targets. So NBFCs must remain compliant with the existing FEMA regulations, and also it is required to maintain the capital to risk weighted asset ratio norms. As a general policy, NBFC shall not be allowed to open branches abroad, but subsidiaries abroad are permitted with comprehensive restrictions to ensure parent company protection and regulatory compliance. Investment abroad, other than in subsidiaries like joint ventures, are also to be governed by the same guidelines as applicable to the subsidiaries. And representative offices are established solely for licensing, market research, and promotional activities, and they strictly prohibit direct commercial operations. So this ensures that international expansion is well regulated and does not expose the financial system to unchecked risk. So for NBFCs under the automatic FDI route, there are defined boundaries. Activities must strictly remain within the permitted list, and any diversification requires prior regulatory approval. New entrants need to comply with minimum capitalization requirements and other RBI norms. The overreaching theme here is the discipline that foreign capital is welcomed, but it must align with India's regulatory framework and flow into permitted, well-regulated activities. So as NBFCs expand their operations, outsourcing has become common. So there are various frameworks with respect to risk management and code of conduct in outsourcing of financial services by NBFC. Typically, outsourced financial services include application processing like loan origination, credit card, document processing, marketing and research, supervision of loans, data processing, and other activities. So RBI recognizes the benefit of outsourcing, but it is equally clear that outsourcing does not mean transferring of the responsibility. The core expectations are to have a comprehensive and robust outsourcing policy that has to be approved by the board. Then to conduct rigorous due diligence before selecting a service provider. Then to ensure written agreements are in place, and there are certain nuances, and a list of what all has to be included in those agreements is also provided in the regulations. So that clearly defines responsibilities, data security, and performance standards. To put in place continuous monitoring and contingency places is also required. So the intention is simple. Outsourcing can increase efficiency, but it must never compromise on the control, compliance, or customer trust. So not every function of NBFC can be outsourced. There are certain activities that are not permitted to be outsourced by the NBFCs. So RBI draws a firm line when it comes to core management and decision-making functions. NBFCs are prohibited from outsourcing activities like internal audit, strategic decision making, compliance responsibilities, KYC checks, or loan sanctioning and portfolio management. There are limited exceptions in the group or conglomerate setups, but even then, the NBFC must ensure that strict compliance and the NBFC retain the ultimate responsibility. Also, while internal audit can be contracted to an external firm, the effectiveness rests with the management and board.
So here, I want to add from my side, this outsourcing guidelines, are one of the important, topic when RBI comes for inspections. Okay. In between also, we regularly get emails from RBI saying that, whether, you have outsourced these activities or not, and, how are you functioning this, if it is outsourced. And one more thing, there is specific mention in the regulation that this regulation applies only for material outsourcing. So not all outsourcing are getting covered under this regulation, but only material outsourcing are getting covered. Now, what is material outsourcing is also, I think, Tulna, it will be covered ahead in future, in other slides. Is it getting covered?
No, it won't
Okay.
be. We have not covered in detail.
Yeah, I will just give you a gist, what is material outsourcing. So material outsourcing is nothing but those kind of activities if outsourced, if you're outsourcing, if that activity gets disrupted, and have a potential significantly impact on the business operations, reputations, profitability, or customer service. So those kind of activities are treated as material outsource. So you have to identify. So what we generally do in NBFCs, so we have an outsource activity register or list that we prepare. We outsource, what kind of things are we outsourcing, whether those activities fall under the material outsource event, whether if something happens to this activity, whether it will fall under the criteria which is given under the material outsourcing definition. So that is how it is prepared. So RBI treats this as very important regulation. You have to comply with each and everything. There are a lot of things that RBI wants to be put in the agreement. They will always ask, if this is outsourced, kindly show the agreement. An agreement should be covering all those clauses which are required to be covered under the this thing. If you are not covering, then you are inviting an attention from RBI. So this is a very important guidelines, and hence we have many slides on this. Yes, Tula, you can continue.
Hemant, one thing which comes to my mind, in fact, when I also seen the NPCs, etc., and all these things, mostly the outsourcing, what they do is related to what you call customer related function, like, customer support, sales and marketing, and the collection of the debts, etc. So these sort of the things are normally given to the outsourcing. When they say restrictions is there any example saying that this can be given as outsourcing or something? Some guidelines is there on that?
Yes, yes. So RBI, what they have done, they have categorically told what things cannot be outsourced and other things can be outsourced. So what things cannot be outsourced is critically mentioned. Your KYC things, cannot be outsourced. Then decision making on this thing you cannot be outsourced. So there are a lot of things which is clearly mentioned. Even
So
if you are transacting with a group company, what are things that is required. If you are there should be a service level agreement. What functions they will be doing, because it is very common that what happens is, consider a company like us. We have many NBCs in the group, so there may be overlapping, or there may be many things, but RBI wants it, though there may be overlapping, but RBI wants it a distinguished way, that how are you ensuring that the activities are remaining with you. So that is how it is very critical, sir, here.
So that means each NBC has to take a extra care to ensure that in no case it actually falls on the things which are actually not to be contracted. Accordingly, they have to take a extra due diligence and ensure the compliance. That is the gist which is actually coming out of it. Yeah.
Yes, sir. And your outsource policy should be very detailed policy, covering
Yeah.
each and everything. So if you are outsourcing something, but your outsourcing policy is not allowing, it doesn't specifically mention. Then also, RBI may think, you are going beyond your policy, and they may come for some observation in your report.
So that means this again calls for, good drafting skill when you are actually finalizing this outsourcing contract.
Yes, sir.
That is the thing. The contract document should be such, you should take care of everything so it covers, so that you don't end up any unforeseen things which actually comes out. So the drafting skill and diligence application also call for preparing this document. Yeah.
Yes, sir.
Thank you. Go ahead. Go ahead, Tulka.
So the RBI guidelines also assign clear roles to the board and to senior management. This two-tier governance model ensures that outsourcing isn't treated as a back office issue. It is a strategic risk area, and it has to be overseen at the highest levels. So from a customer's perspective, outsourcing should never affect their rights. NBFCs must put in place a strong grievance redressal mechanism for services delivered through outsourced partners. RBI expects NBFCs to prominently display the grievance officer's contact detail and ensure complaints are resolved promptly, ideally within 30 days. So, when outsourcing within a group or conglomerate, RBI permits certain shared services like premises, IT, or even legal functions, but there are certain conditions. So, customers must be told clearly which entity is providing the service. Then the agreement must be in writing, and it has to define scope, responsibilities, and confidentiality. then NBFCs must preserve standalone risk management and prevent customer confusion. Even within the group, the same level of regulatory scrutiny applies, and RBI retains full supervisory access. So this ensures outsourcing doesn't become a loophole for risk transfer. And these guidelines are crucial for safeguarding NBFCs and their customers from potential risks associated with third-party related services. So finally, let's look at the offshore outsourcing. RBI takes a cautious stance here because overseas arrangements bring added risk, legal, political, and operational. So before outsourcing offshore, NBFCs must assess and continuously monitor country risk. So there are various risks related to the geographical area or with respect to their uh, law of the land. So they need to assess those as well, and they need to have a contingency plan and exit strategies in place. They also need to ensure that contracts clearly state governing laws and safeguard confidentiality. So certain safeguards are non-negotiable, like outsourcing must never obstruct RBI's ability to supervise the NBFC operations. Also, original records must always be maintained in India. So offshore courts or regulators cannot claim jurisdiction over the NBFC's Indian operations. NBFCs must ensure that outsourcing, whenever is required, the even whether it's outsourcing, whether it's domestic, group based, or offshore, does not dilute the regulatory obligations or customer protection responsibilities, even risk management standards. So board and senior management retain ultimate accountability, and outsourcing arrangements must always preserve transparency and confidentiality.
There are two questions that have actually come to the panelist. This gentleman is actually asking, outsourcing cannot be done to related parties. If it is done, it has to pass through the board or the audit committee and RBI. Please explain this. That is one question. The second question says actually RBI guidelines on cyber security, which is applicable from April 24, is presented rules for third-party outsourcing and data privacy and SaaS audit, and kindly touch upon this. So your views, please. Any one of you?
Yeah. So, sir, the question, once again, let me read the question on RPT.
First question is outsourcing cannot be done to the related party transaction. In spite
So
of that,
it's not that way,
yeah.
sir. You can do outsourcing; it is allowed. There is no issue. You can
Yeah.
give it to a group company. Only thing that is required is what we say. It should be clearly identified what kind of activities they are going to do, what kind of things. There should be a clear contract defined in the service level agreements. When we do it with group company, we have a service level agreement. We have to do RPT functions and all that is governed under your regulation 23 and section 181. That you have to comply. RBI is nowhere concerned about that. But RBI, when you are doing it with the group, there are things that you should comply, which is it should not happen that there is overlapping. There's no clear contract. You are like what do we say? You are giving core functions, decision authority to someone else. Strategic decision is given to someone else. So that RBI doesn't want. So you can very well give it to a related party. That's allowed.
Yeah, that is what I also read actually. If I go through the master circular actually, when it comes to the related party transaction, it actually says let to only adhere with the RBI norms, especially the comprehensive guidelines issued on the outsourcing. That is what it actually says. There is no prohibition there. It cannot be given to the related party things, etc. But only thing is there is as you rightly said, the board approval has to be there, and the robust risk management should be there. Whatever you are outsourcing it, that has to be ensured. That is what it is. And as you rightly said earlier also, even if you are outsourcing even with the related party also. But ultimately, the responsibility remains only with the NBFC, because NBFC should actually prevent and it should take all the necessary care. That is what it actually says, the regulation. Yeah.
Sir, I'll tell you, what RBI wants in the agreement. There is a specific para on
Yeah.
clauses to be inserted in outsourcing agreement. So it,
Hmm.
it says, you should be clearly defining the scope of services, include what things would be there, how confidentiality will not be breached, how is data protected. Then RBI is going one level below. RBI wants, right to inspect and access the records of the service provider also. So that
Yeah,
clause
you
also.
you you actually touched upon the right point. In fact, what RBI wants is system should actually provide access to all the necessary information in order to have the effective supervision. That is what RBI wants. Yeah, go
Yes.
ahead.
So this is what RBI goes into that detail. The agreement should be there. Then there should be plan. Business continuity. If something falls out, what is your backup plan? What is the business continuity plan? How are disaster recovery? What is the DRP plan? So everything is to be included. Then suppose there is some fight between there is a conflict between the vendor and you have to terminate. So what are the termination? What are the exit strategy that you will have? Because there may be situation where the service provider may not provide you the service, the key information, or maybe the key things that you require to function your business. So how you are going to do so, and if you are transferring from this vendor to other vendor, how smooth transition is going to take place. Is that vendor doing subcontract business or not? There are so many things in detail. RBI has given those clauses. So uh, that is how it is, sir.
Next question is asking regarding the cyber security.
Yeah,
Because he says the cyber security, which is actually effective for April 24, is prescribed the rules for the third party outsourcing.
yeah,
And it actually talk about the data privacy and
correct.
the source audit and kindly touch upon this. That's what he says.
So, sir, these guidelines are part of RBI's recent master direction on IT governance, risk and controls, and assurance practices.
Hmm.
What the question is rightly asked, NBFCs must conduct vendor risk assessment when it comes to IT.
Hmm.
Contract must include details on data protection clauses, audit rights for NBFC and RBI, business continuity, which I said. Outsourcing, IT is functions, and it is treated as critical functions. So SaaS audit requirements is there. What is asked, uh, there are a lot of things which because I since this is a very specific question, I don't recollect, but I'm just giving you from the brief discussion that we had in our board. So we have to classify data based on confidentiality. We have to classify data based on integrity and availability. Implement access controls, encryption, and what we say, cyber incident response plans also are required to be given. So and you're required to have information system audits regularly. So that is how it is, sir.
Yeah, you are absolutely right. In fact, the source audit, if we go through it actually, it is nothing but a comprehensive review of the software, which is actually used as the tool for the organization in order to cover the various security complaints the one side. And again, the other side, the data privacy, the misusement, etc., other thing and all that is what there. Yeah, you are right actually. Yeah.
So, sir, I will just add to the previous question of the outsourcing related party,
Yeah.
whether board audit committee approval required or not. So, as Heyman rightly said, that there is no barring on the outsourcing with the related party. Only thing is that company has to take care that those things which are not allowed to outsource, like KYC, those should not be with the related party also. Now, where the board and audit committee is coming in the picture is it's in line with the other related party also. Like whenever we do any related party transaction, there is always a prior approval of omnibus required. So those this kind of transaction also run the pass through those prior approval. Plus, specifically, company need to take care that the transaction wherever the SLA agreement we execute and whatever the commercials we decide, those should be on the arm's length basis and transaction should be in the ordinary course of business. That where the audit committee and board role will come into the approval of the transaction, apart from the other things.
Yeah, absolutely. You're touching upon the very right point, because what happens is all these NBFC companies, they are basically incorporated under the company site. When the companies are incorporated on the company site, they are bound to follow the adherence of the company site actually. The companies has actually got the stricter regulation on the related party transactions. So naturally, they'll have to comply with the related party transactions compliances under the Companies Act, the first instance, and over and above whatever the RBI, because when it's coming to these functions cannot be outsourced, then the restriction that they'll have to comply over and above what Companies Act is required. Because what happens is normally, if the Companies Act is there, okay, if it is a simpliciter Companies Act, you comply with everything. But if you have gone up to a particular sector, then the sectoral regulation which are applicable, in addition to the Companies Act, you have to comply with those sectoral applications, also compliances, you have to ensure. That is one of the things actually coming. Yeah.
Yes.
Now digital lending framework. So NBFCs utilizing digital lending platforms are mandated to strictly follow the fair practice code and outsourcing guidelines. Digital lending has grown rapidly, but so have concerns about the customer protection. RBI's digital lending directions emphasize transparency, accountability, and borrower welfare. So, NBFC must conduct thorough due diligence on their digital partners and ensure compliance with data localization norms and provide strong grievance redressal mechanisms. So, loan terms must be transparent, recovery practices and ethical practices should be done, and customer communication should be clear. The fair practices code applies fully in the digital world, and outsourcing rules reinforce that platforms act as agents. So NBFCs remain responsible for borrower outcomes. So this framework also allows NBFCs to leverage technology while also safeguarding customer interest.
There is one question that also has come, rather than the question, it is, I think, it seems to be a suggestion. There is a similar compliance requirement from IRDA or the NPSC. There is more than 700 questions in that guidelines carrying on the insurance business, like car finance companies, etc. You may touch upon. Any view on this?
Yeah, sir. I mean, IRDA and also it's there are a lot of things. If you are NBFC also providing some kind of IRDA services like insurance and all. Where you are a corporate agent, and there are a lot of things. But sir, this is a very specific question and not related to topic. I think we may skip here for time being, and we may go ahead with
No,
our
sure. Because that is right. Because we are basically on the NPSC and scale-based regulations. You are absolutely right. Yeah.
Yes.
Go ahead.
Raising money through private placement by NBFCs. So RBI has strengthened oversight of private placements of non-convertible debentures. NBFCs raising money through NCDs must follow specific guidelines, and so the guideline provides that a board approved resource planning policy is mandatory, and that policy has to define the planning horizon and periodicity of private placements. Then there is requirement of minimum subscription. So a minimum subscription of rupees 20,000 per investor is required for NCDs with maturity over 1 year. Then there are categorizations for subscribers and issuance. So issuance are divided into two categories. First is issuance of NCDs with a maximum subscription of less than 1 crore. So there shall be a limit of 200 subscribers for every financial year, and such subscription shall be fully secured. Then the other category is above 1 crore. There shall be no limit on the number of subscribers in respect of issuance with a minimum subscription of 100 crore and more. And the option to create security in favor of subscribers shall be with the issuer. So such insecure debentures are also not to be considered or treated as public deposits.
Here, sir, Tulna, you may continue. You're talking on this topic or you're going ahead? So
No,
I
no,
may
on
add
the
some.
No,
same
no,
Yeah,
thing.
just,
Sir, but
you can,
you can add, sir.
no
you
worries.
are
I'll add
free.
later on.
Yeah,
One second. Tulna, complete it. I have some interesting thing wanted to share.
yeah,
Sure, sure,
please,
sir.
please go ahead. We would like
Yes.
to hear.
Yeah. So it's out of the topic little bit, but here, I want to tell you that, company secretary can play a very big role when it comes to NCD's issuance. Because what happens is, while taking a lot of interviews, when I have a requirement of CS and we talk about this NCDs, so I find many times that, people say that this is, liability the liability side looks into, or the finance side looks into. We are just making the listing applications. We don't work on the GID and KID because it's done by them. But here, I have a different altogether different experience in my organization, where this is driven by all three of us. So there is a liability group. Vishal, you may also add if you want to. There's a controllers group, and there is a compliance team. Okay. So what happens is, we work together in a very sync manner, and we ensure that, the document that is prepared is in such a way that, we protect all the interests of the company, the organization we work. The covenants also are discussed in large, whether we can give this kind of covenant, how it can be impactful, to the company, if it something happens, like, stressed like situation. And because we don't know, things are good right now, but what about future, how it happens, how it may work. So we ensure, each and everything, is thought in such a way that whether this will be allowed, whether this kind of indemnity can be given, whether, this kind of clause can be agreed, whether. So, we work together with finance department. We negotiate, in the secretarial team, in our in we are the person, being legal and, compliance together. We are the person who also talks with the banks or the NCT. This is not going to work. This is what we can offer. That is how important role a company secretary plays. So I just wanted to say that, if you in your organization, if they are saying that, it is run by the finance team, I request you can break that chain, get involved. It's a very interesting thing to issue a debenture, work on GID, work on KID and the covenants, and discuss that thing with the investors also. Vishal, you want to add your experience if you want to?
Yes, I mean, correctly said. NCD issuance is the joint teamwork from each department, right from the front office liability team, with the finance team and with the compliance team. There are various people externally also involved, like you need to add trustees on time. You need to take the various committee approval with the proposals, few critical clauses which lender ask, and if it is a first time, then a lot of deliberation happens with the future, as Hemant said, whether we should agree or not, because it may impact the future issuances. Because sometimes clauses are like some covenant they put it on the debt equity capping, or some share change in control or changing shareholding, or uh, uh, so there are many actually covenants. So detailed deliberation requires, and it's not about only finance team. There are covenants which impact the as secretarial compliance team also. It's obviously it's a joint work, and a lot of things comes in the say in the GID KID is like numbers work also. So it's not like if compliance is doing, then no other department will touch that document. So all respective people put the effort jointly, so that the numbers go with the in the document, which is obviously goes to the stock exchange and everything. The people should behave responsibly and take their own ownership, and the thing should come out well actually. So that's what the approach should be from the each department.
Both of you have actually put the point very, very nicely. Although I am not like you, expert involved in so many decades, I had an opportunity to serve in of the group companies where they had almost about 7 NBFC companies in the group company, which are actually a private and also unlisted public companies. And really speaking, there are various issues, there are various things which were actually there. So really, the company secretary has been working along with the team with the other members like CFO and other people who are there and other thing and all. And the company secretary can do really an enormous job. Rather, he should do it actually in the NBFC companies. It is very important because this sector is very important. Because as I said already, it is not only the compliance under the Companies Act is over and above the Master Circular ensuring the compliance is RBI. RBI is actually quick enough to actually come back and raise the queries, and also they are quick enough to respond also. And I have seen the interaction during my short period, about 4 to 5 years. They were very quick. Even they provide the assistant, etc. immediately on the online. All those things are all there. Company secretary can really play a wonderful role in NBFC companies. Yeah, go ahead.
Yes, so private placement activities must balance investor protection and capital raising efficiency. And this requires careful adherence to both RBI and Companies Act provisions, as said by our panelists. Then this is with reference to legal entity identifiers for borrowers. So all non-individual borrowers with exposure of rupees 5 crore or more must obtain a legal entity identifier code. That is a unique 20-digit identifier. So without it, NBFCs cannot sanction fresh loans or renew existing exposure. The only exemption applies to government departments and agencies, and this also excludes the PSU. So the PSUs must also obtain the legal entity identifier. The legal entity identifier system significantly enhances transparency and also allows regulators to monitor interconnected risks across the financial system. And NBFCs are expected to actively encourage the borrowers and their group entities to adopt a legal entity identifiers. And then submission of data to credit information companies. Credit reporting is another area of focus. So RBI's Master Direction on Credit Information Reporting Directions 2025, which came effect from January 2025, they establish a higher standards of transparency and responsible lending. So NBFCs must ensure that data submitted to CIC is accurate, timely, and complete. So even every credit event, including from loan dispersal to repayment and defaults, must also be updated promptly. Then for data quality and accuracy, NBFC must ensure that every piece is submitted that is verifiable. So you need a backing document or a backing proof with respect to every data you are providing or submitting to CIC. Then dispute resolution. So customers must have a simple way to raise disputes if they find errors in their credit reports. So it is our responsibility. Basically, that is the responsibility of NBFCs to address these grievances, and the customers are not penalized for reporting mistakes. Then, of course, it has to do the timely reporting and ethical data use. So, for credit information, as we all know, credit information is sensitive. So, RBI emphasizes that it must be used responsibly and strictly for credit assessment and risk management, and never for discriminatory or unfair practices. In addition to this, NBFCs also are required to display details of on their website, details of their borrowers whose secured assets have been repossessed under SARFAESI. So this list must be updated monthly, and along with details of complaints received, and if a resolution, whatever is provided by the NBFC. Also, the RBI expects customer protection measures from NBFC. So that means timely alerts from CICs, a borrower notification of defaults, dedicated nodal officers for complaints, and a clear grievance redressal timeline. So NBFCs are also required to conduct regular root cause analysis of complaints, and ensure top management oversight of customer service quality.
So on the CIC, I would like to add something.
Please go
So
ahead.
yeah, so the earlier rule was the NBFC need to file the information with the CICs on a monthly interval, and NBFC need to register with the all four CICs, CBIL, CRIF, Experian, and one more. So now the recent change in this is like this requirement needs to be done every fortnightly now. So every half monthly, NBFC need to file the information with the CICs, and within 7 days of the end of the 15th day. So suppose 15th of September return should go, information go before the 21st of September. Now, this is the obviously joint work between the finance team and the operation team, or maybe in some organization you must be finding the operation team takes care of this information because these are the customer related information. Finance team comes into the picture where the various information goes in the this return. So I'll explain this. The one information is the borrower segment, where there is the pen wise information of the borrower, and then related information of the borrower, including the address, contact number, and pen, CIN number, and everything goes. The second sheet, second information goes the relationship of those borrowers. So suppose that corporate is the your borrower, then the relationship is like the name of the directors and everything goes in the filing of the information. The third information goes as a guarantor segment. Like suppose you if you've given any loan, then if that loan has having the guarantee, personal guarantee or corporate guarantee, so those guarantor information also goes in the return. The fourth information is the CR information, which is a credit information. So where it typically goes the loan related information, like the sanction amount of the loan, what is the outstanding, if the customer is having any DPDs, dues, suppose 1 day overdue, 30 days overdue, 60 days, 90 days overdue, that information also goes. Suppose that loan is secured or not secured, that information goes. Suppose customer is having any overdue, apart from the DPD, like number of days, the amount of the overdue also goes there. So those are the information in the CR, plus asset classification also goes. Like suppose this is an SMA account or SMA2 account or NP account. And the last information goes as a security information, like the against the if the loan is secure, then what security amount of the security is against the loan. So these are the information what all NBFC need to submit to the CICs. Recently it is introduced also, like CICs after filing the information, they revert to the respective NBFC with the DQI, which is called as a data quality index. So suppose like you have submitted the 100 count of the information. Now that acceptability of 100, suppose sometime it is 85, 90. So that they revert, like your 15 data lines are rejected, 85 has been accepted. So that data quality index is also now a subject of the monitoring. So this might be asked by the RBI in the future from the NBFC, that the quality of the data what you are submitting, how it, like it should not be very below average percentage. Apart from this, if any customer raise any disconnect with the CICs, say suppose to the CBIL, that the information filed by the lender like NBFC is not matching with my record, or this information is not right. CIC specifically email or communicate via FTP or mostly through the email to the NBFC, that which is called as a dispute resolution. That dispute resolution needs to be give the attention by the NBFC immediately and needs to be resolved. So the things which were earlier and things which is now is more from the NBFC side, is more engagement with the CICs in terms of the filing of the information frequency has increased. Apart from this, quality of the information, people have to watchful that as a compliance team or a CCO role is also come into the picture, where the data quality index should be maintained with a good level. Apart from this, the customer complaint should not be hit NBFC as a backfire, because it needs to be attend immediately and resolve it. So this is the importance of the CICs, and people needs to give enough time and take it very seriously. I mean to say, because it's very critical now. That's it. Hemant,
Just
if
to
you
add
want to
what
add,
Vishal,
yeah.
yeah. So just to add what Vishal said, see, this is very important part, because sir, what happens is this is the place where it impacts your ratings and all. So, your scores and all. So, RBI takes it very seriously. And second is, RBI has if I'm not wrong, in 2024, it had issued a circular which on respect of dispute resolution, and they had clearly mentioned that within how many days NBFCs are required to resolve this, and within how many days CICs are required to resolve this. And if you delay in responding, the person who is delaying is required to pay a penalty of say 100 rupees per day, if I'm not wrong. So that is how RBI has taken it very seriously, because if what happens is once you report, resolution was was taking time, from the NBFC's point of view also, and also from the CIC point of view. But now they have ensured that if you delay beyond these days, you have to ensure 100 per day delay penalties levied. So this is how it has made.
Yes, Tullam, go ahead.
Yes, sir. Now, filing of records of mortgages with the central registry. NBFCs must mandatorily file all security interest with CERSAI, covering immovables, movables, and intangible assets, including under construction properties. So, existing records must be updated within defined timelines. This was when the SBR came into effect in October 2022. And while new or modified transactions must be filed in real time. So, this centralized registry reduces the risk of fraud and ensures transparency for lenders and borrowers, both.
So this CERSAI is nothing but it is a government portal. So what happens is when a company borrows, it has to, if a charge is created, we file a charge form with ROC. Similarly, this requirement is not on the borrower point of view, but it is from the side of the NBFCs who is lending. So they have to file this form, they have to file this return with CERSAI, and this is to nothing but to ensure that to prevent multiple loans on the same property. It helps NBFCs to quickly and verify the ownership and encumbrances on the same property. That is how that is how it is important. It is similar 30 days you have to file in CERSAI, the way it is, and if you don't file, it attracts penalties and all.
Housing finance. So, for housing project financing, RBI has imposed stricter disclosure requirements. NBFCs engaged in housing project financing are subject to specific disclosure requirements. When financing developers, NBFCs must ensure that all marketing materials disclose the names of mortgagee entitled, and builders must also obtain NOC before property sale. Also, the funds are to be transferred or released from NBFC once disclosures are complete in nature. So that is the responsibility of the NBFC, to take up and see that all the disclosures are done, and only then they have to release the funds. So this, yes, Hemant, sir, you want to add?
Yeah, just to add, yeah, the requirement, builder developer must disclose mortgage entity names in pamphlets, brochures, and advertisements. So this is a very difficult, situation when it comes from NBFC's point of view. RBI wants this to be done. NBFCs also want this to be done. but I have seen many NBFCs are not able to comply this. The reason being, uh, still there is a common misconception that if someone writes that this is mortgage to say ICICI Prudential, maybe some ex lender, okay, so they a person who is buying has is not clear why it is mortgage. Because for him it would be a first time home, and when he sees that it is mortgaged, this property is mortgaged to someone else, you know uh, he may not be ready to buy. So builders are like, they don't want to put this because it may create some misconception on the buyer's point of view. At the same time, NBFCs want to put because there's a requirement, and it also protects NBFC, because what happens is under RERA you have to put the money in a dedicated escrow account. It cannot go to builder's account. From escrow account also there is a way it comes to the respective team. Respective portion comes to the NBFC, and other part portion goes to the project where it is there. So there are a lot of things, but this is a very difficult place where RBI and many other people, other agency will have to play a role to clear misconception that if something is mortgaged to a lender, it doesn't mean that there is a problem here. It is that they have taken a loan, and you have to, if you are buying a flat, you will have to take their NOC, and then only you will get a this thing. Without NOC, if you buy, there will be a problem. So this transparency is still required to be created, and taught amongst the lender side and also amongst the buyer side.
So, as Hemant sir clearly said, that the regulatory framework ensures consumer protection in housing finance while maintaining clear boundaries for NBFC business structures. Then there are partnership restrictions on NBFCs now. So NBFCs cannot become a partner or contribute to capital of a partnership firm or even LLPs, and as well cannot become part of association of persons. So partnership restrictions prevent potential conflict of interest and ensure proper corporate governance structures are maintained. Then ratings of financial products of NBFCs. NBFCs with asset size of rupees 100 crore or more shall furnish information about upgrading or downgrading of assigned ratings of any of their financial products within 15 days of such change in rating to the regional officer of the RBI under whose jurisdiction their registered office is functioning. Then RBI has also clarified that fixed deposits with banks are not considered financial assets for NBFCs, and nor is the interest income from those fixed deposits will be considered as financial asset income.
So on the rating part, I'll like to add something. So
Yes,
this rating requirement, so wherever the NBFC has the rating, apart from the RBI intimation, the NBFCs also need to put the rating into the financial annual financial audited financial, uh, and this many of you must be aware that this rating surveillance happens once in a year with the company, and after that they come out with the affirmation of the rating. Suppose some company has like double A, then it's due for surveillance every year, and then after they meet the management, after they study the information they have, they ask from the company NBFCs, and after that they reaffirm the rating, and then the rationale comes out in the uh, rating agency's website, which is a public document where anyone go and can read the rationale, which briefs about the company's strength, weakness, and everything. And then this rating rationale is also a good material for uh, the prospective lenders of the NBFC, where the NBFC needs to borrow the funds. That time, like suppose NBFC is borrowing from say mutual fund market, then those mutual fund team, fund manager, and everyone, they would like to see the rating of the company and the rationale and everything. From there, they have the good takeout about the good inputs about the company. So rating is very much important. Uh, And secretarial team is also arranging every year, which is a mandatory requirement, one meeting with the independent directors, including Hemant, I guess, with the audit committee members also, right?
Yeah, we shall audit with the audit committee
Yeah.
members.
So this is so important that they independently want to meet the audit committee chairman and members for their views. These are the mandatory things. Hemant, you can also add if you have anything.
Correct. So this agencies, they want, what, because they want an independent view. So this meeting is held, during the month of October. Every year they are mandated to have this meeting. So they come up with this. There are no standard questions, as such. They ask a lot of questions to the audit committee chair. They want, they management don't participate in these meetings mostly, and direct questions asked to the audit committee chairman and the members and independent directors. So RBI is doing all kind of role to ensure that the system is protected, and consumers is protected, so that there's no fallout. So the regulations are very stringent nowadays, and the way RBI monitors, earlier it was there were only two ways of monitoring, offsite and on-site. So they used to come, on-site once in a year or maybe twice in a year. Offsite would be, they would ask few by through returns only. But nowadays, RBI, what we feel is RBI is tracking each and every NBFCs on day-to-day basis by asking a lot of emails, specific emails to the NBFC, specific emails to uh, on the returns that you file. They analyze the returns. For example, the KYC return that we file every quarter with the internal audit, they analyze that report, okay, and they tell us that, you may be an outlier on this part, and you place this to the audit committee, and take their view, what they are thinking. So that is how RBI has gone, one way ahead, and we must appreciate the way RBI and other regulators are working on this.
Amit is actually asking, why don't you suggest a software that can be used for the preparation of the data of CICs?
So the best way to make this automate is you should approach your LMS vendor only, because all the information housed in your LMS only, like master, which gives about the borrower information, the related party information, the guarantor information, the information about your collateral security. So the best way to get the CIC report is from your main source system, which is the LMS. This is the most of the NBFCs approach.
I think Savitra has given, I think, sort of a suggestion, I think so. No matter what amount of the monitoring operations are actually in place, a non-viable business of the NPSC will always die a natural death. So it is very important to identify sicknesses and failure to meet the financial obligations. I think it is very true. The RBI also wants to see that only, because there is loopholes and other things are all fixed up and compliance is done, things goes well. That's it. Yeah, go ahead,
So,
Tulsi.
what he has said is very correct. RBI has emphasized on need for early warning signals, systems, stress testings, and board level oversight on many issues. Risk management is now taken a very important role. Risk management committee. They when they come for inspection, they see the minutes, what kind of discussions that happens, what kind of guidance the committee is giving. If, for example, if you place an NPA report, okay, to the committee, just noting is not enough. What kind of guidance the committee gave to ensure that this NPA is reducing. So RBI wants to know that as well. So gone are those days, just you place the report and you just minutize that this was done. There's no tick box approach going to work with RBI.
You are actually right. In fact, I also seen in the companies, my experience was, the risk management committee is interested to place the risk register. That means, identifying the risk, categorizing the risk, the proposed thing, what is there, etc. And ultimately, the thing that used to be there in every meeting, they used to discuss, they used to call for the detailed report in taking the action monitoring. The regular monitoring, as you rightly touched upon, it is very true. Because no regulator wants the company to actually close down. Everybody wants the company to be running actually. So in such a case, they are interested in arresting the early signals and all, taking the corrective action and moving forward. Yeah. Yes, Tulna.
Yes, sir. Now, scoring methodology for identification of NBFC upper layer. To identify NBFC in the upper layer, RBI has applied a structured scoring method. So each of these parameters are assigned a weight and NBFCs are scored accordingly. Those exceeding a specific aggregate score threshold are designated as NBFC in the upper layer, and they are subjected to more stringent regulatory and supervisory regime. Then regulatory guidance on Ind AS standards, accounting standards for NBFCs. So, SBR provides a comprehensive framework for NBFCs regarding the implementation of Ind AS and ensuring consistent and transparent financial reporting. Uh, there are various pointers or various subject matters which are required to be reported in a certain manner as per the guidelines. So there is an unexpected credit loss model under Ind AS 109. Then fair value accounting has increased. Then RBI has also clarified how Ind AS adjustments interact with prudential norms so that accounting changes does not distort the regulatory compliance.
Yeah, Tulna, I can add something on if you're finished.
Yes,
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 sir.
please,
Yes,
please,
yes,
please
yes.
go ahead. Anytime you are welcome without any thing, please.
Okay. So, Ind AS, you rightly said that applicability in Ind AS is the company net worth who are 250 crore and above. In the unlisted space, it is applicable to them, and for listed and companies, it is applicable to everyone. And if it is applicable to the parent, then subsidiaries and associates are also covered in that. Now, uh, as Tulna rightly said, that there is one paragraph in the circular which talks about the Ind AS guidance that if say in the regulation in the RBI, it is mentioned that your investment should be at the cost. Example, and under the Ind AS, now the change is that you need to fair value your assets and liabilities. So hence your investment also needs to be fair valued. Now, whenever you do the fair value of your financial instrument, if it is a valuation is higher than your cost, then you need to recognize that instrument with that fair value amount. Hence, the suppose 100 rupees of the investment, if the fair value is 102, then you need to recognize that 102, and the 2 rupees unrealized gain you need to book. Now, which is slightly disconnect from the RBI's earlier regulation, where it was saying that it has to be with the recognized at per the cost, like 100 rupees. So then the companies who are following Ind AS, then it was a clarification from the RBI that the company who is following the Ind AS needs to continue with the Ind AS disclosure and everything. But they have given some guidance on the net on fund calculation and everything. So suppose in this scenario, your net worth is increased by the rupees 2 because you have booked the gain. Now, when you calculate your own funds and net own funds, there they have given a guidance where the unrealized portion of such instrument, which is rupees 2, you need to remove it from your own fund to come out with the regulatory capital requirement of the RBI. So your book, own fund, and your regulatory calculated capital to that extent will get changed. So that's the guidance given by the RBI under the Ind AS paragraph in the scale-based regulation. Uh, Other thing I would like to touch upon is the expected credit loss. So the difference between these two is also like RBI is saying if your If you have standard asset, then you provide 0.40% of the standard asset provision. Now, under the Ind AS, it says that you on the entire portfolio, you need to calculate or you need to build some model where you will come out with the expected credit loss. Means though your asset is standard, but basis the some industry input information, basis the your historical information, you need to come out with probability of default. So suppose you say that you have standard portfolio of 1000 crore, but market input or suppose your historical experience says that out of 1000 crore, my history says that suppose 1% was always going subsequently bad. Suppose. So suppose 10 crore out of 1000 crore, 10 crore is going bad. Ind AS require that 10 crore to have the ECL provisioning accordingly. So that ECL model talks about, so basically the outcome of the DCL model is your provisioning is slightly different or more than the RBI. But there is a guidance that NBFC needs to continue to follow the Ind AS. So NBFCs recognize provisioning as per the Ind AS. So hence, if you read the peer other NBFCs accounts, their provisioning always look like higher. And as I mentioned last time also, that if you want to understand that what is the gap between these two, RBI provisioning and the Ind AS provisioning, so there is a disclosure also required in the annual financial where you need to put your various category of the assets like stage 1, stage 2, stage 3 as per the Ind AS, and which also required to put your standard, substandard, doubtful assets. And then in the comparison way, you need to put it in different columns. That suppose my standard asset is say 1000 crore. Against that, what is required as per the RBI provisioning, and what the ECL provisioning, what I have done in the books. So the reader can understand that what is the gap between the RBI provisioning and the Ind AS provisioning. But yes, accounts needs to be prepared according to the Ind AS. Now the third change, which relevant to the NBFC only, where earlier few NBFC had a practice to, apart from the loan and charging the interest, they used to take the processing fees income. So many NBFC used to have their accounting policy where their processing fees charge upfront, because against that they need to put some expenses also, that which they need to put a upfront payment to the DSS and everything. The logic behind was that that's why it was like recognizing upfront. Now under the Ind AS, the change is suppose you have given the loan of at the rate of 12% and you are charging 1% fee, suppose. So Ind AS says that 1% you cannot recognize the upfront, but you need to incorporate those rate into the loan only, and 1% you need to amortize, take it over a period of the life of the loan. You cannot take it upfront in the book. So that is also one change in the Ind AS from the previous IGAP version. So and there are a lot of disclosure requirement came under the Ind AS, which was not there under the IGAP. Under the IGAP, the more disclosure was coming from the basic disclosure as per the ICAI guideline, along with the RBI disclosures was there. Nowadays, RBI disclosures are there only. A few more increase with the scale-based regulation, as I explained, the CG report and those deviation, if any, in the asset or provisioning and all those things have come. Apart from this, there are Ind AS disclosure also came to understand the reader properly, how you value your assets and liabilities. So this is all about the Ind AS approach. And one more thing is NBFCs are following Ind AS, but banks are still under the IGAP. So they are following. Yeah.
There is someone who's put up a question. Is Ind AS is mandatory only for the upper layer NBFC or for every NBFC?
It is applicable basis the net worth. If the net worth is below 250 crore, it will not applicable. But if net worth is more than 250 crore of the NBFC, it is applicable.
Which are very well captured on Ind AS.
Thanks, Emma.
There is one question which someone how to treat processing fees where India's is not applicable. Vishal, you want to answer?
So processing fees, as I mentioned, it's up to your accounting policy. So suppose many company as their accounting policy says, processing can be taken it upfront. So suppose you have given the loan today, and on that loan you have taken the fees today, but the loan is of the 2 year, but you can recognize basis your accounting policy in current date only. Or suppose it all driven by your accounting policy basically. So many other NBFC has the practice to take it over a period of the life of the loan. Suppose the loan is for 2 year and they amortize over a period of 2 year, but it's driven by the accounting policy where India is not applicable.
Yeah.
Yes, Tulna, you can go ahead.
Yes, sir. So these are specific guidelines for expected credit loss as discussed previously. Then with respect to lease, with respect to first time adoption of these guidelines, and there are certain exemptions, and to help with the complexity of the transition. Then of course the board and audit committee oversight has to be there for all the crucial reporting. So basically, these guidelines ensure that NBFCs maintain high standards of financial reporting and aligning their accounting practices with global benchmarks and enhancing investor confidence. Overall, this alignment brings NBFC closer to global best practices.
So in this only one thing is under the India's 116 there is a recently clarification from the RBI which were under previously it was very confusing thing, and auditor to auditor people were taking different call when the in the India's 116 where the ROU when it was created on the lease asset in the balance sheet, many auditor or NBFC were taking a stand that it is an intangible asset and it needs to be removed from like deferred tax treatment in from the own fund, but they have recently clarified that no need to remove it, and this is very well considered as a tangible asset only, and there should not be any impact needs to be taken in the net on fund calculation.
Yeah, so project finance. Under the new project finance directions effective from October 2025, NBFCs face specific obligations. So projects, both infrastructure and non-infrastructure, require financial closure and date of commencement of commercial operation documentation before sanction. And repayment tenure is capped at 85% of project life. Then lenders must retain a minimum exposure of 10% for loans up to 1500 crore and 5% or 150 crore for larger loans. There's also a strong emphasis on early recognition of stress and stricter provisioning. So these measures aim to prevent build-up of project-related NPAs.
So in the project finance, I would add few things.
Yes.
Now it is applicable from October 1, 2025. So in the circular, it is clarified that the existing portfolio, whether which will cover under this circular or not. So then RBI has very specifically mentioned in this. So they have bifurcated the portfolio into the two things where whether the loan is project finance, yes or no. And if it is a project finance, whether that loan has been financially closed. If it is a financially closed, then the circular of effective first 2025 will not applicable because it's a prior loan. But if it is a financially not closed yet, then entire circular will get applicable. Now, though it is covered here everything, only I'll touch upon the DCCO part. So where it is mentioned that if the NBFC gives the extension and there is a delay in the project, then in the circular they have given the acceleration of the provisioning per quarter basis. I think it is given 0.375% per quarter. So per quarter, every incremental, it's not one time. So for every quarter you need to provide 0.375 incrementally. So that's one. And as mentioned here, the project has been bifurcated into the design, construction, and operational phase. So, and plus lot of things will change from the prior thing where the NBFC used to give the project finance. Now they need to look at it more extensively, like whether it is financially closed or not, whether and earlier the many a document DCCO date was not spelled out in the agreement. Now it is mentioned in the direction that you need to specifically mention the DCCO date. So those are the changes. And there is some guidance also given on the sale and purchase of those loans also, which is clearly mentioned in the regulation. And earlier there was moratorium also. There was no specifically. NBFC was taking their own way of the giving the moratorium of the loan and everything. But now those moratorium of the loan also given the guidance. So people have to follow that. So those are the major changes in the project finance. And earlier, I think this design phase, construction, operation phase was also not there. Now they have categorically which period is called as design phase, which all period called as a construction phase, and what all called as a operation phase and everything. And accordingly, this loan will get impacted in the NBFC's book when it will ongoing in the book. So very detailed circular. I suggest you you all should read it. Circular is in very detailed one. I'm saying. Thanks.
Yes, sir. Thank you. Then there are specific directions for infrastructure debt funds. So, scale SBR also outlines specialized directives for infrastructure debt funds and emphasizing their crucial role in long-term infrastructure project and financing. So, in infrastructure debt funds are specialized vehicles to channel long-term debt into infrastructure. They must be sponsored by an infrastructure finance company or a scheduled commercial bank. Then their funds come primarily from long-term bonds or debentures with a minimum maturity of 5 years. They can invest only in projects that have been operational for at least 1 year. Then there is strict leverage and asset liability management requirements to ensure the stability. In short, infrastructure debt funds provide sustainable long-term financing for critical infrastructure.
Tulna, I think you can go ahead actually. Wherever the panelists would like to add, they themselves will get into, they will step in. Yeah?
Sure, sir, sure.
Yeah.
Then these are specific directions for microfinance loans. So for microfinance, RBI has issued targeted directions. Borrowers' eligibility is based on household income, which caps on loan amount to prevent over indebtedness. Then pricing and interest caps. So pricing must be transparent and limited to interest rates and processing fees. Then fair practices and grievances. So NBFC must adopt a comprehensive fair practice code and establish proper grievance redressal mechanisms. So these measures strike a balance and enable the financial inclusion while safeguarding borrowers from exploitation. Yes, so to conclude, RBI's SBR represent a thoughtful, progressive approach. So by layering NBFCs and tightening rules for large players and introducing a robust framework for outsourcing, digital lending, project finance, and microfinance, the regulator is ensuring the sector grows sustainably. So together, these regulatory landscapes create a robust foundation for India's financial sector to thrive in an increasingly complex global environment. So we are at the end of the presentation. We thank you for your attention and now look forward to an engaging discussion for your question and your questions.
Thank you very much, Tulna. It was a wonderful presentation, actually. And
Thank you.
you presented everything very lucidly and covering all the things. Every point is actually captured, and definitely our panelists have added value. Now I'll open for the discussion to the participants. They can raise their hands if they want to interact, they want to ask any questions, query, they can raise their hand. They can unmute the mic, they can put up their questions. Over to participants, please.
So I would like to just add, the presentation was really good, and RBI, when RBI comes, I have told earlier also, there's no straightforward answer to anything. Whether you can do this, whether you can do that, very limited. RBI would have told, like Companies Act, it would say that this is the requirement and you have to follow. In RBI, it is truly on spirit, on your wisdom, and how you're thinking. And the last conclusion would be whether it is going to help the consumer, whether it is in favor of consumer or not. Anything which is adverse, it's not what RBI is going to take it serious. Easily. So you, as a CCO or as anyone, in NBFC, whenever things are not clear, you have to think in a way that whether what RBI will think. If you can answer it properly, if you can justify, I think then you are complying with the regulations. But if your answer somewhere you feel that no, this is not going to work, then I think RBI will also think the same way, and you will have to hear something from RBI.
I think I can see a hand risen by Nikhil Patel, who's our very well-known, renowned people who always contribute. Yes, Nikhil, it's a pleasure to hear from you. Please go ahead, unmute your mic and speak.
Yeah, Balaji.
Yes.
Good discussion. I just want to clarify on one thing. As we were discussing about the Ind-AS, what we have been mentioning, that net worth of 250 crores and above invites the Ind-AS applicability. But it could be other way around also. If you are a holding company and your subsidiary is NBFC, which has a net worth, then being a holding company also will invite the Ind-AS. Or you are a subsidiary of a company having, let's say, net worth of only 10 crores, but your holding company's net worth is more, then also it will invite the Ind-AS. So it's not only your own Ind-AS. It will be, net worth of your own company, net worth of your holding subsidiary associate also may impact and invite the Ind-AS applicability compulsorily.
Absolutely, very, very, very valid point.
Yes.
In fact, this particular point was actually came up in the last time, and people discussed it. That is why I did not touch upon that. But as you rightly say, it is absolutely correct.
Yes.
If the parent and subsidiary company is there, if the parent or subsidiary is actually under the intent, automatically other companies are to be under. It's a very valid point, Nikhil.
So today also I mentioned about the subsidiary and associate, but I have not mentioned about the holding company. But yes, he's right.
Yeah.
It is applicable. Yes.
Yeah. Thank you very much, Nikhil.
Thank you.
Yeah. Any other questions? I don't see any other hands risen actually. That's all, I think. So since all the questions have been answered and no one has risen the hand.
And I think maybe panelists can throw some light how you get classified as base layer, middle layer. Because my experience is if you are CIC and not utilizing public funds, still you fall under the middle layer automatically. If I'm wrong, can the panelists on this?
Nikhil, you are right. If you read the scale-based regulation master direction, it is specifically mentioned there also that middle layer also includes the housing finance companies and CICs and all these things. So yes, CICs are ML only.
Thank you.
I think probably we can close the session since all the questions have been answered and there is no query. That's all I think. Yeah. I'd like to take the opportunity of expressing my sincere thanks to both the participants who have been consistently contributing to our webinar. They are sharing their expert view. It really, really helps us to having the practical views from their point of view, because having handled over 2 decades of the experience, etc., we definitely look forward to more such things from you. Thanks a lot to both of you. And thanks a lot to Tulna also as well. I said earlier, my great appreciation for putting the things, everything in the gist and the capsule format and bringing out everything in a very, very simple language. Thanks a lot. With this, we close out the
Thank you,
sessions.
sir.
Wish you all very happy Navaratri. Enjoy the colorful week which is going to come. Have the blessings of the Vata, and we'll meet in the next weekend. Thanks. Thanks a lot to each and every one of you.
Thank you.
Thank you, sir.
Thank you very much.
Thank you.
Thank you, Tulna. Very nicely done.
Sir. Thank you, sir.